If you're investing in Vanguard ETFs, there's one mistake I see beginners and even experienced investors make all the time. It's not about choosing VOO versus VTI or picking the best fund. It's a behavior mistake, and it can quietly destroy long-term returns without you noticing for years. And the reason it's so dangerous is simple. It feels like you're being responsible. So in this video, I'll show you exactly what the mistake is, why it happens, and how to fix it with a simple framework you can use with VTI, VOO, VXUS, BND, VGT, basically any Vanguard ETF. Quick disclaimer, this is for education only, not financial advice. I'll use examples to explain the concept. All right, let's get into it. The common mistake: treating ETFs like individual stocks. The mistake is buying Vanguard ETFs and then managing them like you're trading stocks. People buy a great ETF, something diversified and low cost, then a few weeks later they start asking, should I sell VOO because tech is down? Should I switch VTI into VGT because tech is hot? Should I dump international because the US is outperforming? Should I go all in on the one ETF that's up the most this year? That is the trap: performance chasing and constant switching. ETFs are designed to be the boring engine of a portfolio, built for decades, but people turn them into a rotating door, and that kills compounding. Why this is a big deal and why smart people still do it. Let's be honest, the market is emotionally intense. When an ETF is rising, you feel like you're missing out. When it's falling, you feel like you're being responsible by getting out. And social media makes it worse because every day there's a new best ETF. One month it's all about the S&P 500. Next month it's go all in on tech. Then it's bonds are dead. Then it's international is coming back. Then it's small caps are next. Here's the truth. A portfolio doesn't need constant changes. It needs consistency. The hidden cost: you keep buying high and selling low. Let's do a simple example. Imagine two investors. Investor A buys VTI, the total US stock market, and holds it through ups and downs. Investor B buys VTI, but every time there's fear, they sell and move to whatever feels safer, or they chase whatever is hot. The market drops 20%, Investor B sells to protect capital. Then the market rebounds, Investor B buys back later when it feels safe again. What did they just do? They sold when prices were cheaper and bought when prices were higher. That's the exact opposite of what you want, and you don't need to be a day trader for this to happen. Even switching just a couple times can reduce long-term results because the biggest gains often happen in short bursts, and if you miss them, your returns shrink. The most common ETF version of this mistake. Now, with Vanguard ETFs, this mistake shows up in a few predictable ways. Mistake number 1. VOO versus VTI, buying both without a reason. A lot of people buy VOO and VTI together thinking they're diversifying, but VOO is the S&P 500, large US companies. VTI is the total US market, large, mid, and small. So if you buy both, you're basically double owning large caps and paying attention to the wrong thing. This isn't bad, but it's often unnecessary complexity. If you want simplicity, pick one for your US stock core. VTI is broader. VOO is more large cap focused. Both are fine, but owning both often just makes people second guess themselves. Mistake number 2. Overweighting one sector ETF because it wins. This is the big one. Someone starts with VTI or VOO, then sees VGT, Vanguard Information Technology ETF, crushing returns, so they shift more and more money into it. But sector ETFs are concentrated. They can have massive runs and also massive drawdowns. If you chase the winner after it already ran up, you can end up buying high. Sector ETFs should be treated like a small tilt, not the foundation, unless you fully understand the concentration risk and you're okay holding through deep drops. Mistake number 3. Ignoring international until it works. People often skip international because US has outperformed for a while, so they go 100% US. Then, when international finally has a strong year, they suddenly add it. Again, performance chasing. A smarter approach is to decide your allocation before emotions kick in. The fix: use the core plus rules system. Here's how knowledgeable long-term investors avoid this mistake. Step 1. Build a core that doesn't require decisions every week. A classic simple core is US stocks, VTI or VOO, international stocks, VXUS, bonds, optional based on risk tolerance, BND. That's basically the three-fund portfolio concept: simple, diversified, low cost. You can adjust the percentages based on your risk tolerance, but the point is you're not constantly guessing which region or sector will win next. Step 2. Write rules when you're calm. This is what pros do. You don't create rules during panic, you create them when you're neutral. Here's example rules. I will hold this portfolio for at least 10 years. I will contribute monthly no matter what. I will rebalance once a year, only once. I will not sell because of headlines. If I add a sector ETF like VGT, it stays under 10 to 15%. Those rules protect you from your future emotional self. Step 3. Rebalance, don't rotate. Rebalancing means if one part gets too big, you trim it back to your target. Rotation means you keep switching your portfolio based on what you think will happen next. Rebalancing is disciplined. Rotation is usually guesswork. A simple yearly rebalance is enough for most long-term investors. You're basically saying, if US stocks run up and become too big, I'll take a little profit. If something is down and smaller than it should be, I'll buy it cheaper. That's the opposite of performance chasing. But what if I want higher returns? Good question. If you want to aim for higher returns, don't do it by constantly switching ETFs. Do it by improving the controllables. Keep fees low, invest consistently, stay invested, increase your savings rate, avoid taxes where possible, like using retirement accounts in the US, keep a long-term horizon. And if you want to add something like VGT for growth, that's fine. Just do it intentionally. A smart way: keep a core, then add a small satellite. For example, 80 to 90% in core, VTI or VOO plus VXUS, maybe BND, 10 to 20% in satellite like VGT if you truly understand the risk. The common mistake summary in one line. The biggest mistake with Vanguard ETFs is not the ETFs. It's changing your plan because of short-term performance. ETFs are tools. Your behavior is the strategy. If you want to actually build wealth with ETFs, the goal isn't to find the perfect fund. The goal is to build a simple plan you can stick with through good markets and bad markets, because compounding only works if you stay in the game. If you want, in my next video, I can break down VTI versus VOO versus VGT. Which one should you pick and why, with simple examples for beginners? So comment below, VTI, VOO, or VGT. Which one are you holding right now? And if you found this helpful, subscribe, because this channel is all about simple, realistic wealth building without hype.